Good morning, grade 12s. Recap from yesterday, we looked at the balance of payments account. Remember, you need to know how to do the calculations as well as the line items. So moving on today, we're looking at our foreign exchange markets. Think back to the circular flow model, first topic we did. Your foreign exchange markets are one of your markets. So all the knowledge you learned there applies to this section as well. So we're going to look mostly at exchange rate. So what is the definition? The definition of an exchange rate is the rate at which one country's currency can be exchanged for another country's currency or swapped for another country's currency. For example, $1 equals 15 Rand, or £1 equals 20 Rand 63, etc. So a foreign exchange market, therefore, is the market engaged or involved in the buying and the selling of foreign exchange. Our main leading markets are, as we discussed in the circular flow model, London, New York, and Tokyo. And in South Africa, the Forex market we also call the Bank Foreign Exchange Market. Please remember, it's not a physical location or actual place. The Forex market is basically just what's used to describe when we talk about all the transactions that are involved in the swapping of currencies. So this happens mostly in banks, but there are also different bureau de changes. So every country has its own currency. A currency is only legal tender in the country of origin. So you can't go to America and try and pay for your goods in South African rands. Trading blocs sometimes use a single currency. For example, the European Union, which uses the euro. In Africa, that's also the aim with the African Union, that eventually we get to a common currency, but I think that is light years away. So the nature of demand and supply. So before I continue, I think it's important for you guys to understand that the foreign exchange markets are one of the best examples of a perfect market. So being a perfect market, prices are determined by demand and supply. They follow your basic theory of economics. So when we look at why a currency becomes more or less valuable, we have to look at the demand and the supply of that currency. As soon as the demand goes up, the price goes up, or the value of that currency goes up. As soon as the supply goes up, the value of that currency goes down. So what type of situations would give rise to a demand for foreign exchange? Importing goods, so other countries buying goods from us, they must pay in South African rands, so they have to buy. Services from the foreign countries to the country concerned. Payment of interest and dividends on foreign capital. Payment of installments or on repayments of overseas loans, and the transfer of capital to foreign countries. So all of these things would mean that we need to purchase a foreign currency, and tourists or representatives spending money in foreign countries. Supply of foreign exchange would be when we export goods, provide services, so all the opposite transactions to what we've just looked at. No examples of these. It could be tested in a multiple choice question, not in a paragraph question as such. Perhaps also it might come up in your data responses. Just a short one or two more question asking you for other examples of supply or demand of foreign exchange. So let's quickly have a look at the two important graphs that you have to understand. So looking at the graph on your left, the establishment of the exchange rate, or the what they call the clearing rate in foreign exchange. You can see the vertical axis is marked as rands per dollar, and then the horizontal axis is quantity of dollars. So the equilibrium rate at this point is 8 rand per dollar. So if we look at the two curves, DD is the demand for dollars, and SS is the supply for dollars. People who demand dollars are those who have South African rands and want to buy dollars, and the ones who are supplying are holders of dollars who wish to exchange it for South African rands. So let's say at a price of 6 rand per dollar, there's going to be excess demand. There will be too much demand for the dollar and not enough supply. That means the price will tend to increase. If we look at a price of 10 rand per dollar, there's going to be excess suppliers. They're going to want to sell all their dollars, and that excess supply will drive the price down again to your equilibrium rate. So it's as simple as that to establish the exchange rate. It's the action of supply and demand. At a more expensive price, there will be excess supply. At a cheaper price, there will be excess demand. And the interaction of the supply and demand will drive it to the equilibrium rate or the clearing rate. So these two graphs, they like to ask in your paragraph questions, your 8-mark questions. So they will ask you to explain how an exchange rate is determined with the aid of a graph. Then you draw this graph on the left and explain what will happen at a price of 10 rand per dollar and what will happen at a price of 6 rand per dollar. Then the other graph that they like to ask as well is how, or to explain the appreciation and depreciation of a currency. So once again, if you look, our vertical axis is labeled rand per dollar, and the horizontal axis is the quantity of dollars. So again, we have an original demand and supply curve, and the initial exchange rate is 8 rand per dollar. Any factor that causes a change in the demand or the supply of a currency will lead to a change in the exchange rate. First, to understand what is an appreciation, what is a depreciation. If the exchange rate is currently 8 rand per dollar, and then it changes to 9 rand per dollar, we are now paying more rands for a dollar. So the dollar has appreciated, or the rand has depreciated. If we are paying less rands per dollar, then the dollar has depreciated and the rand has appreciated. Okay, so let's firstly look at a change in supply. What would cause the SS, the supply curve, to shift to S1, S1? For example, if exports from South Africa to the USA decrease, meaning US businesses are importing less from South African companies. So essentially what it means is your new equilibrium point is going to be where S1 and DD intersect. It is now 9 rand per dollar. So we are paying more rands for each dollar, which means the dollar has appreciated, and at the same time the rand has depreciated. Now if we look at a shift in the demand curve, so what would cause an increase in the demand for dollars? Anything like South African businesses importing more goods from US companies, or South African tourists visiting the USA and obviously exchanging their rands for US dollars. So now your new equilibrium point would be where D1 intersects SS, which is now also 9 rand per dollar. which means you're paying more rands for each dollar. The dollar has appreciated, and at the same time, the rand has depreciated. When you discuss the equilibrium points, don't only explain what has happened to the exchange rate, the rand per dollar, but you can also mention what has happened to the quantity of dollars that will be traded. That will earn you marks. So once again, they can also ask you to show a depreciation in the currency. What that would imply is that instead of the D curve, the demand curve shifting outwards, it would rather shift inwards. You would pay less rands per dollar, and instead of the supply curve shifting inwards, the supply curve would shift outwards. And once again, you'd be paying less rands per dollar. Make sure that you are labeling your axes correctly and that you label your curves, your supply and demand curves correctly, the original ones, as well as the ones that will be apparent after the change in supply or demand. And then any equilibrium points you discuss, also label them. So those are the two most important graphs in this topic. Okay, so this is just an explanation of what I've just for your a couple of seconds to read that, but obviously you can pause the video and read it. Okay, so now looking at interventions into the markets, what institution would be intervening in the market? Obviously, that would be the Reserve Bank. So, the Reserve Bank, their main purpose or their main goal is to maintain the value of our currency, and the way they do that, obviously, is by managing the exchange rate. So, the first thing you need to realize is that the balance of payments account and the value of the currency are very closely linked. So we have what we call a mutually dependent relationship. So the deficit or the surplus on the balance of payments account is directly linked to the value of the South African rand and vice versa. So the value of the South African rand will lead to a deficit or a surplus on the balance of payments account. So first looking at what does it mean to be overvalued and what does it mean to be undervalued? Undervalued is when a country's currency is not valued high enough. So it's trading at a cheaper price than it should be. For example, we're paying 9 Rand per US dollar rather than 8 Rand. And the way that we'd see that this is happening is the fact that our balance of payments account would continuously be in a surplus. Looking at the opposite situation where your currency is overvalued, it means it's trading at a price that is higher than it should be. So, for example, the exchange rate is 7 Rand to the US dollar rather than 8 Rand to the US dollar. How would this be identified? By looking at the balance of payments account, and you would see that there would be continuous deficits on your balance of payments account. So the next thing we have to look at, and the last thing for today, luckily, is our interventions into the market. What does the Federal or the Reserve Bank do to sort out these continuous deficits or surpluses on the balance of payments account? So your interventions into the market generally will depend on what type of exchange rate system that country is operating on. South Africa operates on a free floating exchange rate, so they do not use direct intervention. But obviously, in the world, there are countries that operate on a managed floating exchange rate system, which is, I'll explain the different exchange rate systems to you tomorrow. But for now, all you need to know what is direct intervention, what is indirect intervention. South Africa only uses indirect intervention because of our exchange rate system used. So direct intervention, if the currency is overvalued, meaning the price is too high, the central bank can buy foreign exchange. How? By using its gold and foreign exchange reserves, and that will therefore increase the demand for foreign currency and lead to a lower exchange rate. If the currency is undervalued, the central bank will sell foreign exchange in the markets. This will obviously lead to a greater supply of the foreign exchange, and therefore the exchange rate will also decrease. Then looking at indirect intervention. Indirect intervention is what South Africa uses, and it's the most widely used. And we do this by method of interest rate changes. So how do interest rate changes affect the value of a currency? By influencing foreign investors to either invest more into our country or to invest less. Remember, interest rates or interest is the reward you receive when you are investing in a currency or investing in a country. So if the currency is overvalued, it's trading at a price that is too high, we either have to increase the demand or decrease the supply. So if we increase interest rates, it means there will be an inflow of investment, which means a surplus is created that balances out the deficit on the current account, and therefore the surplus on the current account will then decrease. If the currency is undervalued, we decrease the interest rates, which means there will be a lower rate of investment, which means a deficit is then created that balances out the surplus on the current account. So therefore the surplus on the current account will then increase. This section is also examined under the paragraph questions. So study it, understand it, go through it a few times until it makes sense to you. Remember, you have to constantly keep in mind how foreign or how exchange rates are determined, as well as what causes surpluses or deficits on our current account or on our balance of payments account. So just to assist you in helping to understand the balance of payments account and how that will be affected by our indirect interventions. Balance of payments account, debit, or what leads to decreases in our pool of money, and what leads to increases. So debits is money leaving the country when we import goods, invisible imports, so South African tourists, and outflow of foreign capital. Money coming into the country, which leads to an increase or surpluses, visible exports, invisible exports, and inflows of foreign capital. Also transfer payments to South Africa, so any organizations, international organizations that might donate money for education, etc., into South Africa. Your homework for today, I will post on the WhatsApp group